Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, November 29, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And it was quite a day out there today. There was an enormous divergence out here. We're going to talk about all the different markets and where the divergence was, namely in the transports, and even the IWM was up, but the transports were up enormously today, over 3%. We'll get there when we get there. And then there was the Nasdaq, which got killed today on the other side. When we look at the spiders, they were basically flat on the day. The S&P 500 cash index was down about 1 point, and the spiders, you can see, were basically near the flat line. So it's basically a margin of error. It's splitting hairs. It wasn't really up. It wasn't really down. But it was quite interesting out there. We did have significant divergence. And remember last night, we talked about the tech stocks, the FANG stocks, and a couple of the other tech names. That was really the shot across the bow. They were struggling yesterday. Some of them were down. Some of them were down larger than others. And today, they all got thrown out with the bathwater. And the question is it a sector rotation, or are the other markets going to catch up on the downside real quick over the next few days? Now, we did have the GDP revision announcement, or whatever it was today. It was a non-event. It really wasn't a reason why the tech sector was down. That had nothing to do with it. Nobody really pays attention to the tech sector as it relates to GDP. However, tomorrow we do have this pending vote. I believe it's tomorrow evening. We do have this pending vote on the tax reform bill. Now, that could certainly have an impact on the market because the market is waiting with bated breath in terms of tax relief. And that's one of the reasons why you've seen the small cap indexes, the IWM, for example, up large of late, because I think one of the biggest beneficiaries is small business. Certainly big business is going to be a beneficiary, but they've been making profits. They've been printing money. The bigger beneficiary is small business. Small business across the United States can be the biggest beneficiary of a widespread tax cut. And if that happens, that's going to be the reason why the IWM has been in a raging bull market of late. Let's get back to the spider. Now, I've got another line on the chart at 261.25. Could be 261, could be 261.50, could be anywhere in between. You have to give it a little bit of wiggle room, so I'm splitting the difference and saying 261.25. And why is this important? Because if the market comes down and decides to catch up with the tech sector over the next session or two, so Thursday, Friday, in that neighborhood, then I think that's where we're going to find a decent level of support for the market, right around that 261, 261.25 area. You see the bottom of this green candle. Let me move the chart over, and the bottom of the green candle on this daily chart comes in at 260.66. We don't necessarily have to get all the way to the low of that green candle. However, if the market does decide to come down farther, or come down at all for that matter, it's going to want to test near the lows of that green candle, but it's not going to just blow through the low of that green candle like it's not even there. That's just the way markets work. This is now a support area for the market. Maybe it only lasts for a few hours or a day or so, but it should be at minimum of intraday support for the market. Now, there is some further evidence when you look at the intraday charts of where a number like this comes from. So let me show it to you real quick. One of the things I notice on the intraday chart, we're looking at a 10-minute chart right now, is the pivot that I have outlined with the circle. So that pivot should be supportive to the market. That's the way the market's letting us know that in and around that price level was important. The other thing that's important is you did have a consolidation point right here. Now, keep in mind, this is a 10-minute chart, so this consolidation isn't all that important, but this consolidation, a little breakout, a retest of the breakout area, and we know that markets like to come back in and check in at former breakout and former breakdown areas. Now that takes place whether it's on a 10-minute chart, an hourly chart, a daily, weekly, monthly. It doesn't make any difference. All markets act and react the same way. So I'm just looking at the intraday 10-minute chart and saying that price level is important to the market. So maybe it's 261, 261 and a quarter. In that neighborhood should get some intraday support for the market. Now the other thing I notice is you do have a short-term bearish pattern. So here's a down move. We've had bearish consolidation, and this is poised for another down move. Now, of course, we could go up and negate the entire down move if we close above the high over here. That's certainly possible, but I do think that the pressure right now is to the downside in this market. Let's take a look at one more chart. Now, here's the hourly chart. So again, supported by evidence that you're going to have some support here where you have the 20-period moving average sloping up into price. You have a green candle low here. So that could be supportive of the market, but you also have that same bearish pattern that we just talked about. And on the hourly chart, we have a topping tail. So this here is a topping tail, and we've been going sideways after the pullback after the topping tail. This will generally promote another move lower. So the first area of support could certainly be the 20 moving average on the hourly chart in and around this green candle low. But then you have the secondary green candle low in the hourly, which is also the same area we just looked at on the 10-minute chart, where you have the retest of that low and this long tail candle. That was the pivot low we just looked at on the hourly, the 10-minute chart. Then, if you did come down farther, you have a gap fill. And the gap fill area comes in at the same level that you have the 50-period moving average sloping up right where this gap fill area comes in. So even if we did break the 261 and a quarter, 261 area, you do have somewhat of a safety net all the way down at about 260.40, 260.50, 260.35. In that neighborhood, you should find a decent level of support in that area. That's your safety net if the 261 to 261 and a quarter didn't hold. So there's your intraday analysis of the spider using a 10-minute, an hourly, and a daily chart. Before we move on to the next market, let's go back to the daily chart and what negates everything I just discussed. Easily stated, what negates everything I just discussed is a close above today's high. It's that simple. Today is what I like to call a pseudo doji candle. Any close above today's high negates everything we just discussed on the downside. In fact, the likely scenario is even beginning to close hourly above that level negates everything we discussed on the downside. Here's the IWM. Now, the IWM was up much more earlier in the day than it finished the day. Finished up 44 cents, but you see what they put in here is a doji candle. Okay, so the question is this a sign that the market is going to change trend, at least on a short-term basis? Remember, these markets are in a bull market. We're above the moving averages. Technically speaking, from a longer-term perspective, there's nothing wrong with the market. But that doesn't mean we can't have a short-term correction. It doesn't have to be a large correction. It certainly can turn into a larger correction. But right now, I'm just talking over the next couple of days. We can certainly have somewhat of a corrective move, especially in the IWM, after this doji candle. Now, the question is the tax relief bill going to fall apart? If that's the case, or at least a rumor that it's going to fall apart, will certainly shake the IWM up a little bit. And that's if you believe what I stated earlier, that the IWM is up in large part because of the tax relief pending bill. Technically speaking, there's nothing whatsoever wrong with this market. However, what today's activity is telling me is that the likelihood and the odds or the probabilities favor that the market could have a pullback for at least a day or two off of the activity we saw today. Now, let's go over to something else and discuss the transports, because the transports are telling an entirely different story. So here's a big divergence. Yesterday, we discussed that the transports were a far cry from all-time highs. They were about 300 or so points away. And all of a sudden today, the transports opened up and absolutely ripped higher all day long. Now, we didn't close at a new closing high, so the old high was 10,080.51. We made a new high today at 10,090 and change, but we pulled back a little bit and closed below the old high. But this was some kind of move up over 3% in the transports. Now, you know that my two favorite leading indicators of the market are the IWM and the transports. Now, the IWM was up today 1/3%. Okay, we just talked about that. But the transports up over 300 points is somewhat of an anomaly. Now, what's included in the transports? You have rail stocks, you have FedEx, you have UPS, you have other trucking companies, transportation-related companies. It was a raging bull market in the transports today. Are the transports trying to tell us that this bull market is just going to continue higher and there will be no correction, no pullback? And this is the leading indicator telling us that just buy them and hold them and you'll be rewarded. You know what? The transports are telling us something, but I would be a little bit hesitant at this stage of the game just to buy them based on the transport related stocks and the transportation average today. It is certainly an anomaly. It may be telling us something, but remember yesterday, the fact that the Nasdaq components, namely the FANG stocks and others, was down and turned out to be a shot across the bow. So it's hard to read one way or the other which direction this market is going. That we're going to get to the Nasdaq in a second. That got killed today, but the transports are telling a different story. So there's a divergence, and therefore, when we have some uncertainty and things are unclear because of a large divergence, we just wait for more clarity. We don't have to do anything right now. We need the market to really give us a clear signal of what the next larger move is for the broader indexes as a whole before we can jump in one direction or the other. But as you know, I like to analyze the markets each individually in and of themselves, but I use different markets, namely the transports and the IWM, as leading indicators of what's likely to come. So both my leading indicators today were up, even though we had other indexes struggling, namely the Nasdaq, which we'll get to. And by the way, the transports were up on tremendous volume today in comparison to the volume of late. So the transports are telling us something, and maybe it's a sign of what's to come, whether it's, in a few days or right now, we'll see, but the transports are telling us something, that's for sure. We just need some more clarity, and we need the Nasdaq, for example, to clear itself up. And speaking of which, we'll go look at the Qs today, and the Qs were down almost 2% today, $2.90. That's a big down day. This is a reversal. Could it just be sector rotation? Sure it could. But just looking at a chart, this is a reversal day. This is generally going to tell us that more downside is coming. Now, we may put in a bearish pattern off a day like this, but until and unless we close above yesterday's high, this is a reversal that will generally promote lower prices ahead. Now, just as a point of interest, let's take a look at some of the components that really brought down the Nasdaq today. We'll start with Apple, down 2%. Tremendous move. We talked about the potential of a lower high yesterday. Could that be weakness for Apple? As it turned out, so far it is. Google, big down day, down almost $26, 2.5% on Google. Netflix, another FANG stock. We had down $11, over 5%, hit the 100-day moving average and bounced off that. But you can see here that, you can make a case that this was a bearish pattern until we closed above this red candle high, that this was going to play out to the downside. That's what we saw today. Facebook, big down day. Look how many days of upside we just wiped out in Facebook. We came all the way down to this breakout area where we gapped higher. We came to what's called a gap window, and that's where we found low today in Facebook. All this activity wiped out in one trading session, basically wiped out in the morning. Nvidia, another market leader this year, down almost 7%, $14, got killed. Baidu, another leader. Look at this one. So down $9, almost 4%. I can go on and on. I'm not going to do that, but you get the point in which the Nasdaq stocks were getting killed today while everything else was either flat to higher. the Dow was up 100 points. So there is a divergence, and we have to watch closely because the market is always trying to tell us something. Our job is to figure out exactly what the market is trying to say. The last index we'll take a look at before we get to some of the other markets tonight is the Philadelphia Semiconductor Index. And the SOX was down 58 points today, over 4%. Now, when you have an index down 4%, that's trying to tell you something. And also, the semiconductor index is generally a leading indicator of the market as well. And you can see here where the semis were up all year long, and then all of a sudden, in one shot, we came all the way down to where we were at the end of October. So this is trying to tell us something, and our job is to figure out whether this is going to be a one-day wonder based on the activity in the other markets, namely the transports, or are the transports a one-day wonder and going to catch up on the downside? We'll see. We need more clarity. We need more evidence over the coming sessions. Going over to the gold market. So we had another down day in the gold market today. It looked like the gold market wanted to break out to the upside. Couldn't make it happen. We never were able to close above the red candle high. And this kind of analysis serves us well. That's the red candle high, and that comes in at, let me get that off, that comes in at exactly $1,299 spot 60. Yesterday's close, let me move this over. Yesterday's close was $1,299 spot 20. We didn't close above the red candle high. We couldn't do it. This turned out to be a bearish pattern playing out to the downside. Now we're below the moving averages, could potentially be heading lower. Again, I've been saying this for days and days and days. When you don't have clarity, there's nothing to do. Both gold and silver are telling us, they were telling us diverging things. One was going in one direction in terms of the chart pattern, the other in the other direction, and then they actually flipped, and it's very difficult to get a read on both these markets. And when that's the case, we just do nothing. We analyze them, we watch them, we look for evidence, and when that evidence presents itself, then we could potentially have a trade either to the up or the downside. But in terms of the gold market, this is really just going back and forth, not giving us any clear indication of a bigger or larger move in one direction or the other, so we'll just leave it alone. When you go to silver, now silver had the breakdown. Remember the important level, 16,769. That was the green candle low that we said silver must stay above on a daily chart closing basis in order for this bullish pattern to stay intact. Well, today we got comfortably below that level, and what happened was this pattern that we've been watching for a couple of days, this pattern, this breakdown candle, bearish pattern, began to break down yesterday, talked about it, and then we had follow through to the downside today. Silver looked bullish until it didn't, and right now it doesn't. We had a close below, or we will close officially today below the 16,769. That takes the bullish pattern off the table, and the next area of support is going to be this pivot low right down here at 16,444. Both gold and silver of late have been very difficult to get a read on. They've been going back and forth, flipping patterns, one looking bearish while the other was bullish, and then the other looking bullish while the other was bearish. Vice versa, back and forth, you get the point. Crude oil, where did we come today? We came right into home base and bounced off that level. The larger picture for crude oil is there's nothing wrong with this market. Now, if we begin closing below the 20-period moving average, then the next major area of resistance, support, becomes this zone right down here. This was really the former breakout area. We consolidated in this zone. We broke out. We could come back and retest this, but if this doesn't hold, we'll come right to the 50-period moving average, and then this former consolidation point right in here. It's a stair-step approach, but that's what I see for crude oil. Right now, as long as the 20-period moving average holds, crude is still in a bullish fashion above all the moving averages, and we can still get up into that $60 area and potentially beyond. Markets always like to come back in and check in at home base, former breakout and former breakdown areas. It happens over and over and over again. We watch it on all charts, all time frames, all the time. The bond market, big down day today in the bond market, And you see here, we just couldn't get through this area. Here's the red candle, breakdown candle high. We couldn't get through there. We tried it once, pulled back, tried it again. Now it's failing. We came into the 50-period moving average, and this is pretty much where we're settling out for the day. There's a gap fill down here. I don't know if we officially hit that or not. Yep, looks like we officially hit that gap fill. So the gap fill was officially at the 151.25, and today's low was 151.24. So we did fill the gap today. It's not to say that this bond market can't go higher. It's just we had a big breakdown today, and a big down day like this generally has more follow through. Not 100% of the time, as we know nothing in the market is 100% of the time, but generally speaking, that's the market's way of telling you on a big down day or a big up day that there's more coming. Unless those big days are found at highs on a big down day and lows on a big down day, that could potentially be the sign of an exhaustion move. But in the middle of a range, you're not seeing an exhaustion move. You're generally seeing a move that has continuation in the cards. And by the way, the reason why we discuss the bond market and a day like today had an impact on the financial sector. And we didn't talk about the financial sector. The XBD, which is the broker-dealer index, was up about 1.5% today. And the XLF, we can take a look at the XLF real quick. The XLF was also up almost 2% today. And this is at new highs. So new recent highs anyway. When you take a look at the long-term chart, it's not at new highs, but this is in a raging bull market, at least for now. And so the reason why we look at the bond market is because when the bond market is down, interest rates are higher. When interest rates are higher, it's positive for the banks. What happens with the banks are the spread between what they borrow money and lend money at widens. So interest rates being up impacts you and I. And that impacts the banks because when the spread widens, they're borrowing money at a much cheaper rate than you and I can. When we have to pay more for money because interest rates are rising, that means the banks are making more money, and that spread goes right to the bottom line. So when you see a big decline in the bond market and a spike in interest rates, at least on a temporary basis, that's positive for the banking sector. Of course, there is a point of diminishing returns for the banks because the higher interest rates go, the more stifling effect that can ultimately have on the economy, but we're nowhere near any place like that. That's a longer-term viewpoint. But a one-day wonder like this generally has a positive impact on the banks. And on a one-day wonder, it's really a matter of perception, but perception is reality in the market. The market is never wrong. Traders are wrong, investors are wrong, people are wrong, but the market is always right. The last market we'll take a look at tonight is the dollar. The dollar still can't get above the 100-period moving average. We didn't really do much today, pardon me, in the dollar. And as you see, nothing's changed from yesterday. The dollar has to get above the moving averages to really stage a rally. We did have a normal garden variety 618 retrace when you take into account this pivot low and the pivot highs up here. This was a 618 retrace. We'll find out if that's meaningful or not in the coming days. If the dollar is going to stage a rally, we have to get above these moving averages. We have to get above this red candle high. We haven't been able to do that yet. So we'll see what the coming days and weeks bring for the dollar. And with that, it's everything I wanted to and intended to discuss tonight. I know it's a little bit longer than normal, but I had a lot to say, so be it. So I appreciate everybody tuning in. This was another episode of Common Sense Market Analysis. I'm David Frost. Thanks for tuning in, folks.